Hello everyone, welcome back to my channel. This is Satish. In our last video, we tackled a big question, stocks versus mutual funds. What's the best for a passive investor? And we concluded that most of us want to go the mutual fund route because it basically hedges the risk and all of that. Now comes the next big question. There are so many types of mutual funds. Where do you begin? In today's video, that's exactly what we look at. This is a beginner-friendly guide to understand mutual funds in India. We'll break down all of them into 5 categories. By the end of this video, you'll exactly know what each of the fund type does and which one might suit you the best. So this video is specifically designed for passive investors who want to get started. People like you and me, right? Who want to grow wealth without tracking stock charts daily or following the news daily. So these are the 5 categories of mutual funds we'll cover in this video. Equity, debt, hybrid, commodity, and international. So we'll go slightly deeper into each of the equity funds because that is where most of you as beginners would invest. So that is why we'll focus on that more. We'll also touch on the debt and hybrid funds to some extent so that you can understand them to balance your risk. Now, before we get into fund types, one quick thing as a basic I would say, right? A good amount of mutual funds in India are based on NSE. NSE is nothing but the National Stock Exchange. When you hear items like Nifty 50, that's basically short form for the top 50 companies that are traded on the National Stock Exchange. Now SEBI, the India's stock regulator, has categorized mutual funds based on the market cap, essentially the how much it right? Basically the size of the companies they invest in. So let's dive in. Now let's talk about the equity mutual funds. So these are the funds that invest directly into the stocks of companies. Equity means stocks, right? So these have higher return potential, but naturally they also come with a higher risk. Now, depending on the size of the company they invest in, the equity funds are divided into different categories. Let's go over one by one. Again, this is like 101 of mutual funds. Think of it like the first one is large cap funds. So these are the companies, these are the funds where you invest in the top 100 companies by the market cap. So these are the giants of the Indian stock market. So these are usually very stable, less volatile, and a great starting point for beginners. For example, some of the stocks that would be part of this, or some of the funds that are part of the HFT large cap fund. And there are some SEBI regulations around it. The regulation is that 80% of the fund's money should be invested in the top 100 companies on the National Stock Exchange. So the next one are mid-cap funds, right? So the mid-cap mutual funds go a little bit smaller. You're investing in funds from 101 to 250. These offer more growth potential, but also carry more risk. Again, SEBI requires that 65% of the fund to be invested in the mid-cap stocks. Now comes the small-cap funds. So these are target companies ranked 251 and beyond. Again, you are arranging from 1 to 500 or more, right? By the entire and by the market cap. So the target companies ranked from 251 to beyond. So these are small emerging businesses. These funds usually come with a very high risk, but also the possibility of high rewards. So these are best suited for someone who are investing for the long term, like 8 to 10 years, and who have a higher risk appetite, right? And who can handle market ups and downs. So then comes the next category, next type called flexi cap funds. So here the fund manager has the freedom to invest in any company, large, mid, small cap. It offers the flexibility for the fund manager to move with the market, but still 65% of the fund must be in equities. So that's the core idea. Multi-cap funds are more structured. So in multi-cap funds, at least 25% should be invested in each of the large cap, mid cap, and small cap stocks. So it's a much more balanced approach with a clear structure. And finally, large and mid cap funds. So in these funds, the funds need to invest at least 35% in large cap and 35% in mid cap stocks. So this is ideal for investors who want a bit more aggressive aggressive approach than large cap, but not so much risk as large cap. So the key takeaway here is your risk appetite and your investment goals will decide which of these equity funds is the right fit for you, right? So that's the basics, right? Now let's talk about one more popular category called index funds that everybody talks about, right? So these are very popular in the passive investors arena. So these funds don't try to beat the market. There is no fund manager who's trying to use his brain, who's trying to use his expertise. Instead, they really replicate the market movements based on the market index like Nifty 50. Essentially top 50 companies, right? So for example, HDFC in the Nifty 50, right? HDFC makes about 13% of the Nifty 50. So then the index fund would invest 13% of your capital into that HDFC fund and so on, right? So essentially you basically, if the market, the way it's moving, they're replicating the index and your money is going accordingly. There is no active fund manager here. So to do the stock picking. So usually what happens is the fees is lower here. There is less risk of bias and very transparent structure. Of course, you don't get a lot of advantages as well of the fund manager expertise. It's just moving in the market. But this is very ideal if you're looking for the very long term with stable growth without really constant tracking the market, right? In fact, to be honest, most of my investments have gone into index funds. I will share a detailed list of what I've invested in all of that and why I bought them in the next upcoming videos. But that's where most of my investment have gone. Now let's move on to the debt mutual funds, right? So these are the funds that invest in fixed income instruments like government bonds, company debentures, or even loans to banks. So basically, these are alternative to fixed deposits. Think of it like that, right? That's how it works. So basically what happens with these funds are you're lending the money to companies or institutions, and in return they give interest, right? So based on how long the money is lent to them, the debt funds are divided into different categories. So overnight funds, let's say if they give the money for one night, then it's overnight funds and liquid funds. So these are overnight liquid or ultra short-term funds, anywhere from 1 to 91 days. See, these are great for parking idle money, right? There are short duration funds as a category, right? Typically for 1 to 3 years. So it's a balance of safety and returns. So there is all medium duration funds which are meant for 3 to 4 years, which have slightly higher returns but with moderate risk. So long duration funds go beyond 7 years, and these are for someone who have a longer time horizon. And here is the bonus, right? The thing with fixed deposits is you have to pay the taxes every year, irrespective of you cashing them or not. But here, you don't pay the tax every year on these earnings. You only pay tax when you actually sell the funds. So the advantage here is you have the compounding effect of the money when you're investing in debt funds, right? A little bit of that, right? It's basically tax efficient, right? So if you're looking to manage your investment on a safer side, debt funds are definitely worth considering to balance your portfolio. Now comes the hybrid funds. So the hybrid funds are where there is a mix of equity and debt in different proportions. So ideally, this is for someone who want to grow the wealth, but with a moderate risk or less risk rather, I would say, right? So we won't go into all type of the hybrid funds, but we'll look at just one of them. Example is a balanced hybrid fund. A balanced hybrid fund would have 60% in stocks and stock-related instruments, or equity kind of ones, and 40% debt instruments. So there is less. So with this distribution, there is less volatility with the equity, but better returns of the pure debt, right? So again, it's a mix of both of them, right? It's a great choice for conservative investors or first-time mutual fund buyers. So let's quickly look at the last two, right? The commodity funds and the international funds. Let's start with commodity funds. So let's say you want to invest in gold. Now you go to gold shop and buy an ornament, right? But again, there's a lot of expenses involved to that. So instead of putting all your money buying jewelry and putting in lockers, instead of that, you could invest in gold-based funds. So these track the price of the gold, and as the gold prices rise, your investment also grows accordingly. It's a smart way to hedge against inflation or any uncertainties in the global markets with macroeconomic changes like wars and all of these, right? Now moving on to international funds. So international funds are one where you want exposure to the international markets like US or Europe. These are things like that, right? So for example, you have funds like S&P 500 or NASDAQ in the US, and you want to invest in those companies which have companies like Apple, Microsoft, all of them, right? But you want to do from India, then you can invest in international mutual funds. And these are sometimes available as fund of funds because these guys are investing in another fund in that, and they manage all the taxes and all of that for you. So this is a great way to diversify your portfolio beyond domestic companies. And this is a very good way to diversify your risk from currency risk and all of that, when you go for international funds. So again, there's a lot of information I told. Let's try to wrap it up, right, so that you are clear on what. So there are 5 major mutual fund types or categories: equity-based funds, debt-based funds, hybrid funds are a combination of both of them, commodity-based funds, and international funds. So within equity, we went deeper into different market categories. So we also discussed index funds, debt types, hybrid mixes, and other global options. So again, there's a lot of information. Feel free to go back and watch it again. It's a lot of information that we threw in today. If you're just starting out, don't try to learn everything at once. You learn as you go along, right? Start small, reduce your risk, and start small with large caps, and then that's how you start building the portfolio. Again, thank you for watching this video. We'll break down how to invest based on your goals and how I have invested my portfolio in the next videos, right? So that way you can follow my journey and learn from that as well. So if this sounds helpful, hit that like button, do subscribe for getting regular updates, and tap that bell icon to get notifications. Thanks for watching. I'll see you in the next one.